100% Mortgage 2023 version. Now, what I'm not going to do is give you all the features of the 100% mortgage that Skipton have introduced, because everybody's done that to death. And besides, you could get ChatGPT to tell you that, or you just Google it. It's not a difficult thing. But what I want to do now is to explain why I think brokers are wrong. There's a lot of brokers, when they've been interviewed about these things, say, oh, my fear, contagion, locust infestation. How dare they introduce the 100% mortgage? It's going to destroy the housing market. And it's wrong on all levels, and I want to explain why that is the case. I think it's Project Fear. Brokers introduced this thing called Project Fear, a bit like Project Remain, wasn't it? Project Brexit, whatever it was. So 100% mortgages, we know what they are. We don't need to be reminded. Effectively, we've got a property, or whatever the property looks like. They're not doing new build flats because they lose their price very quickly, like a new car off the showroom. So we're looking at houses, and they're looking at about £600,000 at the moment. And the whole point is that the house is bought with a 100% mortgage. So your mortgage, let's put that there for you. It's your little sort of, it's 100% of the value of that property. Simple as that. It's not much more to it than that. There's no deposit, nothing like that. Now, of course, the brokers are all concerned that this is going to destroy the market, because they're all getting very sort of official looking, But of course, it won't. Now, the first problem they've got is that it will cause negative equity. If negative equity happens, what's going to be the repercussions for the broker? And the thing is, of course, that the brokers lent the money, the borrower's in the house. If the house price goes down, would it cause negative equity? Of course it will, only if they sell it, because it's a paper value, isn't it? Will the house price go down? Well, who knows what's going to happen to house prices. But what the mortgage company has cleverly done is they've made these 5-year fixes. They're looking to get people that are going to be there 5 years, over a 5-year period. It might get a little bit, but it'll go up over 5 years. Always has done, always will do. So the prospect of negative equity, it's not really going to happen. And if people are forced to sell because they can't afford the mortgage, the government, of course, have introduced or reintroduced SME now, support for mortgage interest, which is actually payable after 3 months now. They've increased the period. It used to be 9 months, isn't it? So even if somebody's made redundant or whatever, they will still get government support to pay the interest. So chances are negative equity won't be a problem. And the whole point about 100% mortgages, of course, is that you buy it and then the house price hopefully goes up, or you've got a repayment mortgage, which you're paying off the mortgage each month. So after 5 years, not only will the house be slightly higher in value, we hope, of course, but the mortgage will be lower because you will have paid off capital. So it'll be around about the 95% mark anyway, even if the house price is. So I don't think that's a problem. The second one is affordability. Now, affordability, again, is not a major problem because they are assessing people cleverly and securely. They're looking at rental income, 12-month rental. Are you renting? Where's the evidence of your rent? Have you paid all your bills? You have great. You guys can run a house. That's fine. I think it's like dealing with a second-time buyer, effectively, if somebody who's already had a mortgage. It's the same concept. So the question is, and this is the big issue for this session really, is where does the lender get its security from? Because if you think about it, the lender's lending 100% value of the property, so it shouts danger, danger, But these things have been around before. I mean, when I started off in broking in 88, 89, 90, we had 100% mortgages. Of course we did, and they carried on all the way through to about 2008 when they stopped with the financial crash because the regulator, because they missed the financial crash, you see, thought they'd get a bit tough, so they banned all these things, and 100% mortgages went because they felt they were risky. I don't think they were, but there we go. So where does the lender get its security from? Well, first of all, they've got the house. So they've got the house as security. And again, will it go down in value? It might do. It probably won't. So the house is always there as security. Second security that many lenders used to is a high lending charge. Now this is interesting actually, the high lending charge, because back in the day when we arranged 100% mortgages, we had to arrange high lending charges or mortgage indemnity guarantees to the tune of £25,000 policies or percent, and people used to pay £2,500 to sort of £3,000 in fees for these things. Very expensive, but it gave the lender security. It was like an insurance policy. So if the person was they defaulted, they had to repo the house, and they lost money on the mortgage, the lender could go to the insurance company and claim against the insurance. But I don't think the Skipton have a higher lending charge. I think they're using the government's guarantee scheme, which I'm going to look at in a second for you. Now, the government's guarantee scheme, which was brought in a couple of years ago, has been extended now to the end of 2023. And it effectively allows lenders to lend up to 95%. So it's not 100%, I get that, but they're probably using a little bit of that. They have to pay for that because the interest rate's higher. The interest rate that they're charging is around about 0.75% more than the average. So I think they're using that to buy the government's guarantee scheme and probably self-insure themselves. So they are getting a kind of higher lending charge back, which I think is really quite an important thing to do. The last security, if you like, is the mortgagor. Now, do you remember the mortgagor as opposed to the mortgagee? That's the borrower. The borrower is the mortgagor. Now, as I mentioned before, they're vetting these people very, very carefully. These people have to have a track record of rent and bills and council tax to be able to run a house, a property, maintain it, whatever it is. Renting, I guess, not total maintenance, but it's a little bit there going on. They are used to running a house. They're used to paying a mortgage, if you like, in the form of rent. So they are actually vetting these people very carefully. They're not being stupid with this. They're doing proper underwriting. So that's good security as well. The interesting one's the high lending charge, isn't it? Whether they are self-insuring, I think they probably are, but they do. These building societies, by the way, have been lending for some of them 150 years. They know what they're doing. I worked for one for many years. They know what they're doing. They're not going to rush into this. They're not stupid, and I don't think anything's going to come to harm. I think it's a great scheme. I really do. I really think these are great things. We had them for 20 odd years. They help a lot of people buy a house the first time. Once they're in, they can then start paying off the mortgage through capital repayments. House price goes up, hopefully they can then remortgage or move on. It's a great stepping stone, and I'm really pleased it's come into the marketplace. 100% mortgages. This may well change the first time buyer landscape. I think it will. I think that's the key thing. Lack of deposit is stopping first time buyers. Anyway, that's been useful.